Hello there and welcome to FX Street Currencies in Play, brought to you by Royal Financial Trading. I'm joined by Marc Ostwald, who's a strategist at ADM Investor Services. How are you today, Marc?
I'm very well, thank you.
And we were just discussing off-air our relief that the euro rally has stopped a little bit. 114.40 or so was the peak yesterday and early today. A bit of an overshoot there, possibly?
I think there was a bit of an overshoot. Part of it was exacerbated by the fact that on Wednesday there were a lot of very big options trades expiring. And that just exacerbated the scale of the move. I think the important thing is going to be this evening when we get the commitment of traders data, because I think what we're going to find is people are now very, very long of euros. So the momentum behind the move, particularly when one considers it from the aspect of, when we talk about the ECB shifting its language, because this has really been the driver of it, what are we actually talking about? We're talking about them starting to taper. The idea that they're going to be raising interest rates any time before the second half of next year is very, very far-fetched. In the meantime, we might have another 1, 2, maybe even 3 Fed interest rate hikes. And on that basis, you look at the interest rate differential, which drives a lot of the exchange rates, and you do wonder really how much more upside there is on this.
Okay, let's have a look at the trending stories of the moment. Aussie dollar nears critical resistance of 77. Pound dollar descending, broadening wedge breakout ahead of the UK GDP release, and then dollar yen finds some support near the 100-day moving average, but still weaker below 112. Any highlights for you?
I think the Aussie dollar is probably the interesting one here, because they're about the only major central bank of the G10 central banks which hasn't signalled a change of heart. Now, one of their things obviously has always been that they don't like seeing a strong Aussie dollar, but we had a change of heart from the Reserve Bank of New Zealand a couple of weeks ago, and it wouldn't be surprising, for me at least, to see the RBA actually become rather more hawkish. Job vacancies in Australia getting very strong growth there. Growth is probably going to pick up quite a lot, so we could see a change of narrative there. So you could see a big test of that level.
Right, let's have a look at the live charting. We're going to start off with the Australian dollar there, 15-minute chart. Not particularly inspiring. I suppose, if anything, you're looking for it to fall back or fade the 77 level. We just overshot that earlier on.
Yeah. Yes. I think you definitely need to see this change of narrative. At the moment, they look like they're the ones who are going to be lagging. So while we're talking about tighter or less accommodative central banks elsewhere, everyone's looking at the relative strength of the Aussie dollar of late and saying, well, they're definitely not going to hike. I wouldn't count on that.
Okay, just to enjoy the view of sterling, which obviously did not hold 130. It was a big level there. I think a big chart. I think all roads lead to that 130, trend lines coming down, and obviously the top of the range, etc. So is that it for now, you think?
I think it is it for now, because really what we want to see is the colour of the Bank of England's money. So it really depends on the data that we've got coming up and whether people really believe, because what we need to remember is what Mr. Haldane and Mr. Carney have said is we need to have a serious discussion about it. That doesn't actually necessarily mean that they're going to deliver on a rate hike. So, and having had the move that we've had, it's not surprising there's a bit of profit taking, A, and B, that people say, well, yeah, let's see them actually do it.
Okay, well, let's go on to the trade of the day, which is, as you may know, a favourite of mine. Euro sterling, bearish divergence evident on the RSI oscillator and MACD. Which may be the case. Sell euro sterling 87.60, stop loss around 87.90, take profit 87.20, risk reward ratio 1.33. So I suppose you can see it in that range, but I think the assumption that many people have is that this is about 5 pence too high, this cross.
I think there are a lot of people who think it's 5 pence too high. I'm not sure that I would necessarily agree, when one not necessarily looking at it from an interest rate aspect, but a relative growth aspect, and given the uncertainty surrounding the UK, I don't think it's actually unreasonable that the euro is, relatively speaking, strong. But I think this is a range trade for the time being.
So basically, if there'd been no hint of any interest rate hike, this would be well through 90 by now. Is that a fair thing to say?
90 would be a bit of a stretch, but I certainly think we could be retesting that high back there for, that's Yeah, well, yeah.
But I'm just saying, if Carney and friends
Yes.
hadn't hinted at that,
Yes.
it would be much.
It would be. It would actually be a lot weaker than it already. Sterling would be a lot weaker than it is.
Save the day,
Yeah.
at least for the time being.
Yeah.
Okay, let's go on to trading positions amongst people, retail people mostly. Euro dollar short here, presumably now that it's gone through 114 and come back, there'll be less pain for those people. Same with the pound dollar as well. They've been short throughout the move. Dollar yen, is that sort of a different situation that you would say?
Yeah, dollar yen is an interesting one because the Bank of Japan really needs some help from our much weaker yen to get inflation going. We had the inflation data this morning, basically zero at the core level. They're not getting anywhere with their QE program in terms of picking up inflation. So at some stage, if we're not too concerned about the world, because the yen has definitely been the safe haven of choice from American woes, from European woes, from UK woes, if we put those to one side, then the case for a weaker yen actually becomes stronger, particularly when one's looking at the economic data, which is hardly impressive.
Right, okay, well let's move along to the economic calendar if we can. Personal income at 12:30. In Canada, GDP 13:45. We've got the Chicago Purchasing Managers Index, and then Bank of Canada Business Outlook Survey. So, as you hinted to us earlier today, Canada's actually in charge today, as far as
I think so. Yes, I think that's a significant data because it could be absolutely decisive in terms of the Bank of Canada's decision on rates in July, and they have been hinting quite strongly that they may hike rates then, and that will these particular items, given you're looking at 3.3% year on year for GDP, which is pretty robust by Canadian standards. If that comes in strong and the Business Outlook survey is optimistic, then I think one can probably safely say that they will be thinking of withdrawing some of their stimulus in July.
But I mean, the dollar, Canadian dollar, 129. What's that? 84 at the moment. It's very weak. Very weak indeed. We've had it's tumbled over the last few sessions. Do you think that's going to continue?
Well, it's had a double tailwind because not only has the Bank of Canada suddenly turned to the idea of interest rate hikes, but it's also been helped by firmer oil prices. So my question would be is if oil takes another downturn, because I don't think a lot of people really believe this rally is anything more than a correction at the moment, will the Canadian dollar start to feel some headwinds? And that's definitely a possibility. And they'd feel even more headwinds, obviously, if the Bank of Canada doesn't deliver on its hint.
Marc Ostwald, Strategist at ADM Investor Services, thanks for joining us today. That's it for the Currencies in Play, brought to you by FX Street and Royal Financial Trading. Obviously, share us and like us on social media if you can.